All right, glad to have you back. The Monetary Policy Committee will hold its first meeting for the year on Wednesday and Thursday, with expectations that the committee will retain monetary policy rate, also known as the benchmark interest rate. The Central Bank of Nigeria had pushed back the MPC meeting to February 19 to allow the release of Nigeria's longer-awaited rebasing consumer price index. That figure came out earlier today, and inflation now stands at 24.48%. And that's what we got from the NBS. Nabila Mohammed is an investment analyst with Chapel Hill Denham. She joins me to look at this conversation. It's good to see you, Nabila. How are you today?
Very well, thank you. Good afternoon. Thank you for having me.
How did the figure come to you when you saw it from the NBS? 24.48% is what we have for January 2025.
I mean, we were not surprised, to be honest, because we had already penciled down a lower year-on-year inflation when we see the rebased numbers. So seeing the inflation print at 24.48% was something that we already expected to happen based on just looking at history now. The last time that this was rebased, that was exactly what happened to year-on-year figures. But we did see month-on-month, increase higher because, of course, the new base now starts at 100. But all in all, it was in line with our expectation to see lower print for January 2025, since it was going to start with the newly rebased CPI.
Thinking that this will one way or the other shaping that conversation, because clearly the MPC would have that meeting and it will start tomorrow, and of course by Thursday we will get the outcome. Do you think this would shaping the conclusion or the outcome of that meeting one way or the other?
So we all understand that the reason in the first place why they moved the meeting by 2 days, that's to start Wednesday and now Thursday, instead of the previous Monday and Tuesday that was planned, based on the MPC calendar, we know that it's because of the data that will be released by the National Bureau of Statistics, because the decisions that will be taken at the MPC meeting, the first for this year, would largely be driven by data that is being considered during the meeting. And now that we have seen the data set, a couple of thoughts, of course, will cross the minds of market participants. What should we see? What should we expect rates to, sort out or be at currently? And what we are expecting in-house is that we would see them retain, that's our expectation, retain the policy rate at 27.5%. However, it would be a mild surprise if we see a 25 to 50 basis points cut in the policy rate to, 27.25 or 27%. Now, it will also be a major surprise to us if we see them, aggressively cut by 50 or 100 basis points, and also make some adjustments to the asymmetric corridor. So all these things, we have looked at it, but what we do see is that market participants are already pricing that in, because fixed income market seems to be buzzing currently, as investors are seeking to lock in the high rates just because of this possible anticipation of what the MPC would do come Thursday when they announce the decisions that they have taken post the meeting. So all in all, we are expecting at the minimum for them to hold rates steady. And the reason is because this data set, or this rebased CPI, is a new set of CPI figures that will be, or inflation figures that will be coming out. It would be, more reasonable to allow for more of this data sets to come out, that to see February print, to see a couple of other months before they now decide to just aggressively lower the interest rate. We like that currently, based on the new inflation number, we are seeing that we have a real policy rate that is positive of around 3.02%, which was not the case previously with the way the old series were. So I would expect that these monetary policy authorities would, just observe these new data sets and see how it performs. Because let's be reminded, the new rebate series is going to be measuring 960 items versus the 740 items that was previously measured in the old data set. So if we are going to be seeing that much addition to the basket of items that are being measured, to arrive at what the CPI is, and of course what the inflation rate is going to be, it would allow for, a little time to really see how this is going to be in the next month before they aggressively decide to cut rates. So I believe these are the things that they would consider when it comes to price stability on the inflation side of things. Another thing that would be on the table, of course, would be FX. We've seen relative stability since the start of 2025. In fact, on a year-to-date basis, we've seen the currency appreciate because it closed at 15.36 at the end of 2024, but now we're seeing 15.15, 15.09. So all these things are what they would evaluate. They will evaluate the impact of all the policies that they have brought into place in order to address FX stability issues and liquidity issues as well. So all these two areas would be the focus of this MPC meeting, and they would look to see how they can continue to strengthen in terms of ensuring price stability.
Indeed, it's not going to be easy in that room. You would agree with me. This conversation will be a very serious one, considering what the MBS has come up with today. Volatile agricultural and energy prices, considering all that has been put together. But I'd like to ask you, what do you think the impact would be if there is a drop, particularly with the rail sector that I've always complained? Remember, we've had this hike consistently, I think since about 2022, 23, we've had this hike. So if there is a drop, what impact do you think it will have on the entire rail sector and the larger economy?
I mean, when we look at the real sector, if we even just look at the data that was released by TVN in terms of the surveys that they have conducted across different businesses, especially in the real sector space that you're asking, they complained about high interest rates. And that deterred a lot of them from, tapping into the capital market or even approaching banks for long-term financing. What we saw last year was bulk of them staying at the short end of the curve, because you would agree with me that there is no business that would want to lock in high rates based on how high the rates were last year in terms of long-term financing. But if we see a drop, we should see more of them become emboldened to, tap into the capital market and also even approach banks in order to get financing to carry out their capital expenditure projects or long-term projects that they would need to expand their business. So that is what I would expect of the real sector. And if that happens, it would mean more economic activity. Now, it would also improve, our purchasing managers index score that, we track on a monthly basis, and we will see that would translate to output, which is the GDP expanding in terms of economic activities, and most likely a stronger real GDP growth when we look at, the impact of all this on the economy at large. So first of all, the drop would, signal that, okay, those that are in need of long-term financing to expand their businesses would now be emboldened to step into the market, to tap into the market and access financing for their businesses. More business and more money to do business would mean more business activities, more economic activities. It would also mean more output from these businesses. And of course, it will trickle down to the overall economy in terms of growth or improved growth, if I may put it that way.
Clearly, again, this rate is lesser than the present MPR rates that we have running in the economy. But let me ask you, Nabila, what other methods, what other policies, what other initiatives do you think government can adopt at this time to help still address inflation? I know particularly everyone will talk about food inflation, which has remained very high, and once a man can feed, part of a major problem is sorted out. Yeah, you agree with me. And so what do you think government should look at specifically regards to agriculture?
So one key issue with agriculture is that insecurity that has always, subdued the activities in that sector. And the monetary policy authorities cannot do anything to address insecurity. You would agree with me. So that is largely the burden of the fiscal authorities to make sure that they continue to address that insecurity problem. Now, aside insecurity being the major problem, we also have other issues around infrastructure in that space, because most times it's like our agricultural sector is a seasonal kind of business. Let me put it that way. So if it is not raining season, no activity is going on because there is no infrastructure to ensure that there is irrigation system across and all that. So these are areas that I feel the fiscal authorities can look into in terms of addressing the challenges that are being faced by the agricultural sector. The monetary authorities have little or no control over what goes on in that space. So it should really be left up to the fiscal authorities to address. We like some of the policies that they did bring in, which is the fact that they were going to introduce, or the introduction of the 10,000 agro rangers sometime last year. So the impact is still yet to be felt, because we're still seeing some of these northern states that are supposed to be the hub of food when you look at cultural activities experiencing high inflation. Aside that, we have issues around flood, which you would agree with me is more or less like a factor that is beyond the control of either authorities, is it the MPC or the fiscal authority. So all these things can be addressed if we look at those areas I earlier mentioned, which is the insecurity and also infrastructure in that space, to ensure that there is an all year round production or agricultural activity ongoing in that space. And again, you know that with the food index that has reduced to 40%, is expected that even at the 20% that we see food inflation brings that, it is lower when we look at it on a year-on-year basis. So, yeah.
All right, then, Nabila, Mohammed, I must thank you so much for joining the program. As always, I appreciate your time and your intelligent contributions. Investment analyst, Chapel Hill, Denham. Enjoy the rest of your day, and let's wait for the GDP figures.
Definitely. Thank you for having me.
All right, then.